It's March 2020. The world is shutting down in real time. In Zurich, a bullion dealer refreshes his inventory screen. Silver coins out of stock. In New York, futures prices plunge even as retail buyers flood online dealers. In Mumbai, premiums on physical silver quietly double overnight. And in London, the nerve center of the global metals trade vault managers start receiving an unusual request. Deliver metal, not contracts. This isn't panic. Not yet. It's something more subtle and more dangerous. On paper, silver is everywhere. Millions of ounces trade daily. Prices update every second. Charts suggest deep, liquid markets humming along like clockwork. But beneath that surface, something fractures. The price says abundance. The shelves say scarcity. Then comes the contradiction. Silver prices fall during the crisis, yet silver disappears. Mints ration sales, refineries delay shipments. Dealers stop quoting prices altogether, and this keeps happening. In 2008, in 2020, during inflation scares, during currency crises, during wars, every global shock produces the same result. Silver becomes hard to find exactly when it's most needed. So it's actually breaking. Is silver a failed hedge, or is the market designed in a way that guarantees scarcity at the worst possible moment? Because this isn't a story about investors hoarding coins. It's a story about a financial structure that treats silver as both a paper asset and a physical necessity, and what happens when those two worlds collide. Narrative structure, the genesis and the promise. Silver's role in the financial system begins long before modern markets exist. For thousands of years, it functions as money, not symbolically, but mechanically. It stores value, facilitates trade, and anchors trust in systems where trust is fragile. When the modern financial order emerges in the 20th century, silver doesn't disappear. It evolves. Governments demonetize it, but industry absorbs it. Electronics, medical instruments, solar panels, silver becomes a critical industrial input. Unlike gold, it's consumed. Once used, it often can't be economically recovered. That creates a paradox right out of the gate. Silver is both money and raw material. To manage this dual role, financial markets step in. Futures contracts, forwards, and unallocated accounts promise efficiency. Instead of shipping bars across oceans, traders exchange claims. Price discovery becomes centralized. Liquidity explodes. The promise is elegant. A futures contract is simple. An agreement today to buy or sell silver at a set price in the future. Originally, this helps miners hedge production and manufacturers lock in costs. It smooths volatility. It stabilizes supply chains. Over time, the system abstracts further. Unallocated silver accounts allow banks to pool metal. ETFs offer silver exposure without delivery. Derivatives stack on top of derivatives. The key assumption underpinning all of this is quiet but absolute. Most people will never ask for the metal. As long as contracts settle in cash, the system works. Like a fractional reserve bank, it only needs to hold a fraction of the underlying asset. On paper, this is efficiency. In reality, it's leverage. And leverage is stable until it isn't. The propagation and the hidden flaw. By the early 2000s, silver trades less like a metal and more like a financial instrument. Hedge funds speculate. Banks market exposure. Algorithms arbitrage price differences measured in fractions of a cent. The London Bullion Market Association (LBMA) becomes the center of gravity. It's not an exchange. It's a network of clearing members. Trades are mostly over-the-counter. Transparency is limited. Reporting is voluntary. Here's the hidden flaw. The same ounce of silver can be claimed multiple times. Not illegally. Structurally. An unallocated account isn't a specific bar with a serial number. It's a promise. Your silver is part of a pool. The bank can lease it. Lend it. Use it as collateral. Multiply this across ETFs, futures, swaps, and industrial hedges. And you get a layered system of paper claims resting on a relatively thin base of physical metal. Estimates vary, but conservative analyses suggest that for every ounce of physical silver available for delivery, there may be dozens, sometimes hundreds of paper claims. This works because under normal conditions, nobody demands delivery at scale, but crises aren't normal conditions. Crises change behavior. They convert abstract exposure into a demand for certainty. And silver, unlike fiat currency, can't be printed to meet that demand. The catalyst every silver scarcity event begins the same way. Not with a run, but with a shift in incentives. In 2008, counterparty risk explodes. Lehman fails. Trust evaporates. Investors don't want exposure, they want possession. In March 2020, the trigger is different, but the result is identical. Supply chains freeze, flights stop. Refineries in Switzerland shut down. Suddenly, even existing metal can't move? At the same time, monetary stimulus reaches historic scale. Trillions are created in weeks. Real yields collapse. Silver becomes attractive from both sides. As a hedge against monetary debasement, as an essential input for future infrastructure and energy systems, retail demand surges. Industrial users scramble to secure inventory. ETFs absorb massive inflows. Then the pressure hits the fault line. Futures prices fall due to forced liquidation. Margin calls don't care about fundamentals. But physical premiums rise because supply is constrained. This is the moment the system reveals itself. Paper silver trades on confidence. Physical silver trades on availability. And availability is finite. The mechanism diagram, verbal walkthrough, picture this like a plumbing system. At the top, you have financial markets futures, ETFs, unallocated accounts. Water flows fast. Pressure is absorbed by derivatives. Most transactions never touch the pipes below. At the bottom, you have physical silver mines, refineries, vaults. The pipes are narrow, flow is slow. In calm times, demand stays upstairs. In crises, demand rushes downward. Everyone tries to turn claims into metal at once. The system isn't designed for that, it can't be. If it were, the cost would destroy liquidity during normal times. So instead, it relies on a behavioral assumption: panic will be contained. When that assumption fails, scarcity isn't a bug. It's the result. The central paradox: silver's market is built to provide constant liquidity in calm periods by sacrificing resilience during stress. The very structure designed to make silver easy to trade ensures it becomes impossible to source when certainty matters most. The hedge only works until everyone needs it. And that's not accidental, it's systemic. By this point in the investigation, one fact is unavoidable. Silver doesn't become scarce because people panic irrationally. It becomes scarce because the market is engineered around paper efficiency, not physical truth. What comes next is the critical question. If this is a structural feature, not a one-off failure, what does it mean for today's markets? Because silver isn't alone. And the modern financial system is now built almost entirely on similar assumptions. The catalytic failure and the modern landscape, once the fault line is exposed, regulators step in not to rebuild the structure, but to stabilize it. After 2008, official reports quietly acknowledge the problem. The CFTC investigates concentration in silver futures. The LBMA publishes reassurances about vault holdings. ETFs emphasize custodianship language carefully crafted by lawyers. But the architecture remains unchanged. Because changing it would require a trade-off the system refuses to make: less leverage in exchange for more resilience. And leverage is the lifeblood of modern finance. Silver's market survives each crisis not because it resolves the contradiction, but because confidence eventually returns. Investors settle for cash. Industrial demand normalizes. Physical delivery requests slow. The pressure releases. But nothing fundamental is fixed. In fact, the system becomes more abstract. Silver ETFs grow larger. Derivative volumes expand. High-frequency trading accelerates. A growing percentage of global silver exposure exists entirely as digits in clearing systems. Then comes the modern twist. Silver is no longer just a hedge against financial instability, it's a strategic material for the future. Solar panels require it, electric vehicles depend on it. Medical technologies consume it permanently. Unlike gold, silver is burned into products and lost to landfills. This changes the supply equation irreversibly. Mining output grows slowly, ore grades decline. Recycling can't keep pace. So now the silver market carries three simultaneous roles. 1. A financial hedge. 2. An industrial necessity. 3. A speculative instrument. Each role behaves differently during stress. And they collide during crises. The modern thread, ETFs, trust, and the illusion of access consider the silver ETF. On the surface, it solves everything. Retail investors get exposure. Prices track closely. Shares are liquid. But structurally, ETFs don't remove the scarcity problem, they concentrate it. Authorized participants can create and redeem shares using physical silver. But retail holders can't. They own a claim, not a bar. In calm markets, this distinction doesn't matter. In crises, it matters enormously. Because when fear spikes, ETF demand absorbs available physical metal faster than the retail market ever could. Metal flows into vaults controlled by a handful of institutions. The result is counterintuitive. ETFs function smoothly while coin shops run dry. From the outside, the market appears orderly. From the ground level, silver vanishes. This creates a two-tier reality. Financial silver remains liquid, physical silver becomes scarce. And history shows which one people trust when systems strain. The broader blueprint. Silver as a model for modern finance. This is where silver stops being a niche commodity story and becomes a universal case study. Because the same structure exists everywhere. In sovereign debt markets where derivatives dwarf underlying bonds. In repo markets where collateral is rehypothecated repeatedly. In crypto exchanges where customer assets are lent, staked, and pledged. In private equity, where valuation rests on models, not exits. Each system is built on the same assumption. Not everyone will ask for the real thing at the same time. Silver just makes that assumption visible because it's tangible. You can't roll over a solar panel input. You can't print metal. You can't digitally settle industrial demand. When the abstract meets the physical, abstraction loses. The analytical framework. How to read future crises. So how does a viewer use this knowledge? Not to predict prices, but to read structure. Here's the checklist silver teaches. 1. Paper to physical ratio. How many claims exist relative to deliverable supply? 2. Settlement optionality. Can obligations be satisfied in cash instead of the underlying asset? 3. Behavioral assumptions. What happens if trust breaks simultaneously? 4. Supply elasticity. Can production respond quickly, or is it constrained by physics? 5. Crisis incentives. Who benefits from cash settlement and who needs delivery? When these factors align, scarcity is not a surprise, it's an outcome. Silver just happens to expose it cleanly, repeatedly, and publicly. The resolution. Returning to the opening question. So let's return to that moment. The dealer refreshing his screen, the vault manager fielding delivery requests. The premiums rising while prices fall. This wasn't chaos. It was the system functioning exactly as designed. Silver didn't fail as a hedge. The market failed to reconcile its dual identity. A metal treated as infinite on screens is finite in reality. And every crisis forces that truth to the surface. Understanding this isn't about hoarding coins or predicting the next shock. It's about recognizing the architecture of modern markets, where efficiency is purchased by fragility, and liquidity is borrowed from trust. Silver becomes scarce during every global crisis because it sits at the boundary between paper promises and physical limits. And when stress tests the system, boundaries matter. That's not just a lesson about silver. It's a lesson about how finance actually works.